Hey everybody, it's Bruce here with Stock Markets with Bruce. Welcome to my channel today. Thank you for subscribing to my channel, giving my videos thumbs ups, and leaving me comments. Today's topic, it's all about Tesla. Should you buy Tesla shares or should you buy Tesla options? I'm going to explain the differences between the two strategies, the risks and rewards. Those of you who are following Tesla, you know the shares have been very volatile. Before the split, they went from about $200 a share to $2,500 a share. They split 5 for 1. They reached that $500 level, which used to be $2,500, and right now they're sitting at $372. Let's take a look at this chart right here. In the last 3 months, you can see the low, 196, the high of about $500, closing at 372 Friday evening before the pre-market kicked in. Here is the last month. Low in the last month, $325, high, 500, closing at 372. Even in the last 30 days, a lot of volatility. Now, if you've got about $4,000 lying around, I'm going to give you an example of how you can buy and sell Tesla. You could buy 10 shares at $372, which is the close on Friday night. We'll run you $3,720. But you can also buy a call option, and what that means is a call option gives the owner of the option the right to buy 100 shares at a set price for a set time without obligation. Once you buy the contract, the owner of 100 shares will say to you, yeah, you can buy them from me up until a certain point in time for this price if you want to. If the shares go up in value, your contract is more valuable. If they go down, your contract is worth less money. One call contract that is exercisable at $400 a share until October 23rd of 2020 will run you $40 a share or $4,000. So you now control 100 shares of Tesla, whether you want to buy them at 400 or not, until the 23rd of October. Let's see what happens if the shares go to $450 in the next week or so. If that happens, the 10 shares that you would have purchased would now be worth $780 more than what you paid for them. So from $3,720 as $780. But that call option would be worth $3,600 more than what you paid for it. There's an interesting return. Here's another one. What if the shares actually go to 500 again? That's where they just were a few days ago, a week or two ago. Well, the 10 shares would now be up $1,280. So you'd be up $1,280 on the $3,700 investment, but one call contract, you would be up $7,500. It would be worth $11,500. This is why people buy options. But what's the downside? Let me show you that. If the shares drop to $350, the 10 shares would be down $220 in value. You'd still own them, but they'd be down $220 in value. But if the shares drop to $350 in the next 7 days, that one call contract would be down $1,000 in value. If that stock is at $350 and the shares, your option, you still hold the option 2 weeks from now, you're down $1,800. After 3 weeks, you're down $2,800. And at the end of 4 weeks and beyond, your contract is practically worthless because you're not going to buy the shares for $400 each if they're trading at $350 on the open market. The person that sold you that contract for $4,000, they're happy because they get to keep the $4,000 that you gave them because they gave you a contract that said you can buy shares from me for $400 a piece up until October 23rd. But on October 24, the contract is no longer valid. It expired. The shares are at $350. You're not going to buy them off of me for $400, obviously. So I get to keep the $4,000. You're out $4,000. I'm up $4,000. Although the shares were $372 a few Fridays ago, and now they're at $350. I'm down $22 a share from where they were trading at, but I got a $4,000 compensation package from you because you bought a contract from me. Of course, the buyers and the sellers of the contracts don't know each other. These contracts are just like the share certificates. They trade on the open stock market. And so there are thousands of people who offer their shares through contracts. They have to have at least 100 shares in their possession to do it. There are thousands of people who buy and sell contracts all the time. And it's theoretically possible that you could buy the contract for $40 or $4,000. 3 days later, sell that contract for $5,500 because the shares went up $15, $20 a share. and someone else bought that contract off of you. You don't know who the buyer is because, again, it's the open market. That person bought them for $5,500. They might sell them for $6,000 or $7,000 or $8,000, or they might be left holding the bag if the stock goes down below $400 a share. You never know. That's how the market works. Obviously, you can buy a contract today that expires October 23rd and hold it for an hour, a day, a week, or right to the end if you want. It's totally up to you. What's your risk-reward ratio? What kind of return are you expecting? There are people who buy and sell options by the hour. They get in, they get out. They get in, they get out. If they lose $400, $500, $600, they dump it right away and they try something else. They don't want to lose all their money. But on the other side, if the options go up in price, they might decide, well, I paid $40 a share for that contract. Now they're trading at $48. I'm going to put in a $45 stop loss order. So if it backs off to $45, I'm automatically taken out and I'll lock in a $45 price. But if they go higher to say $54, $55, I'll change that $45 sell price to $50. And I'll keep moving my stop loss higher and higher and sort of trail behind the market because I don't know how high they're going to go as far as these shares go. But when they reach a certain point and they start backing off, I'll be taken out at that higher level. And that is a strategy that a lot of option traders employ, as do stock traders. Of course, if you own the shares, 10 shares, they fluctuate in price. You don't have to worry minute to minute, day to day what they're doing. On the other hand, if you need money in the next week or so to pay bills, and you had $4,000 in your nest egg and the $4,000 is now worth $5,000, you might want to sell your stock and take the $1,000 out of there and leave the $4,000 behind and buy into something else and see what else you can do. I mean, there are people who do that, but if you're a long-term investor and you feel that these shares are going to go to $700 or $800 a share, and you're buying them at $372, you're not going to worry about the minute-to-minute trading of the stock. You're just going to hold the shares and wait out the moment in time when they reach the price you want to get. But an options trader doesn't have that luxury. An options trader, the enemy is the clock. If you're the buyer of the contract, the clock is your enemy. If you're the seller of the contract, you created the contract, the clock is your friend. Because every minute that goes by, every day that goes by, that option has one less day to live, and it becomes less valuable, especially if the price that the option holder can pay for those shares is at a higher level than the actual price of the stock. And right now at $372, a $400 contract is what we call $28 out of the money. It's a $400 price to buy the shares when they're only trading at $372. So the value, the $40 value, is all-time value. The amount of time between now, September the 12th, and October 23rd. So with say 10 days left to go before the options expire, or 12 days left to go, they won't be worth $40 each. If the stock is $372 and the exercise price is $400 and these options expire in 2 weeks, they don't have 5 weeks to live. They've only got 2 weeks to live. They might be only worth $20 each, even maybe $16 each. Every day they depreciate in value if they're out of the money. On the other hand, if the shares are trading at $440 a share and you have a $400 contract with 2 weeks left to go, the contract is worth $40 a share because you're already up $40 plus a little bit of time premium on top of that. Might be $10. Now they're trading at $50 each. But remember, you paid $40 5 weeks ago or 4 weeks ago, and now they're only worth $50, even though the shares have gone up to $440. This is the problem with options as far as a holder of the options go. It's a depreciating asset right up until the last moment. Of course, on the last day of the contract's life, if the shares are at $440, your contract is worth $40 and you've broken even. But the shares have gone up a long way. You've made no money. That is the scourge of the options market. I hope that helps explain it to you. It's a fascinating world. We'll stay on top of these stories. We'll talk to you next time. Bye for now.